or produce at a certain price for a certain another commodity. So it was basically a commodity-backed transaction or a commodity-backed swaps and futures contracts or agreements between the two parties or more. So then now in modern treasury management and also in bank treasury management, it has evolved to even include even more complex risk mitigation measures, especially if you are trying to, for example, lock in a particular interest rate. For example, let's say KCB Bank, I as KCB Bank, I have a variable or a floating rate debt, okay, that I borrowed, let's say in the interbank market borrowing. So I can use, as we have discussed before, I can use an interest rate swap to lock in, okay, a particular or even a swap. No, in this case, I can use an interest rate swap in this case to exchange one currency for another. That for the debt that I'm going to pay, instead of paying it in one weaker currency, I'll be paying it in another comparable currency. Let's say the KCB Bank has a USD backed loan portfolio, okay, no asset portfolio, loan portfolio that it is paying, for example, in the interbank market for borrowing. So let's say a loan of a billion Kenya shillings, okay, but it's supposed to pay it in USD. But the USD has so much strengthened against the Kenya shilling that KCB, should it pay in USD, it will lose a lot. So KCB can enter into an interest rate swap agreement with another party, instead with the party to instead of paying them in USD, to be paying them in another currency, for example in the euro that is comparable. Okay, so in that case, the treasury managers at KCB will have done what we call risk mitigation as part of treasury bank treasury management to be able to lock in or to be able to hedge the firm or the bank against interest rate risk in this instance. So interest rate swaps, options, and also even futures, interest rate futures, you can use a future contract to lock in a particular price so that you are hedged against any risk fluctuations in the interest rates in the market. So now that's how derivatives, especially in this case, an interest rate swap or option or futures, has grown and has advanced to be able to be used by banks and treasury managers, even fund managers, to lock in or to mitigate their firms and banks and reserve banks against interest rate risks. Okay, what about forex risk? You find that in forex risk, for example, is very common in companies that have subsidiaries, international companies. Let's say KCB Bank has around seven. I think the latest DRC is their seventh or eighth, thereabout. So let's say KCB Bank operates also in Kenya, Tanzania, Uganda, Burundi, Uganda, and now DRC, and they mentioned Rwanda too. They're in seven countries that I know. So you can lock in or you can use, for example, derivatives to risk yourself. To risk mitigate yourself from risk, especially in the fluctuations in the exchange rate of between two currencies, because at the same time they're in Kenya, they're also in DRC. DRC, what do they use? I think francs, right? Yeah. So the DRC franc that they use, they could engage in the derivatives, either option swaps or currency swaps, interest rate swaps, no, forex swaps or forex options or forex futures, to be able to lock in a particular exchange rate of the Kenya to the DRC franc. Okay, so that, let's say, when they have an ALM strategy or an ALM mix, for example, asset liability mix in both countries, then they're able to even lock in a future price to and hedge themselves against any unfavorable fluctuations in the price or in the price of the Kenya shillings in relation to the franc in DRC, where they are also in. Another thing, also, this can even be used by a trader, international traders. Let's say you are a trader, okay? A trader in Kenya. Oh, I am a trader, right? I'm a trader in Kenya. I'm importing some machinery from China. I'm importing bulldozers. Bulldozers. Mhm. And so I'm expected to pay in Chinese yuan, right? Chinese yuan, but I operate in Kenya. So, for example, in this case, I can use, for example, a forex forward contract with my supplier in China that's supplying me the bulldozers, so that we can lock in a particular exchange rate to the of the Kenya shillings to the Chinese yuan, so that should there be any unfavorable fluctuations or forex risk, as we call it, between the Kenya shilling and the Chinese yuan, then I can mitigate the impact of that adverse movement or fluctuation in the Kenya Chinese yuan relationship. So I can use forward contracts. I can even use options that I will have the right, if the forex rate, the rate of exchange between the Chinese yuan and the Kenya shilling should move unfavorably past some predetermined price, I can have the right but not the obligation to pay at that price or at a lower price. Let's say it's a floating rate. Okay, so whichever the Chinese yuan Kenya shilling will have floated rate, whichever rate it will have floated to, I will have the option to either pay it at that rate. Should it be less than the predetermined rate that we agreed. Or we can even use swaps also in this case. We can, instead of paying, they want me to pay for their bulldozers they are supplying me in Chinese yuan, I could pay them in euros or another stable currency that hasn't moved or fluctuated or been impacted by forex risk. And then also commodity price risk. Now this is what we've been talking about, how even derivatives started being used, commodities, and also what Carrefour engages in that I was telling you about. So it's basically price gouging. Carrefour engages in price gouging. It basically enters into, for example, futures agreements with their suppliers, the people supplying, for example, people supplying them with the maize that they stock in their Carrefour supermarkets. So they engage in in futures contracts to say that for the next, as I mentioned before, in such agreement, they also must define clearly the terms of the agreement. For example, the periods, the rates, and also the amounts. Okay, so Carrefour enters into forward agreements with their suppliers that for the next 1 year, you'll be supplying for me 1 million bags of maize flour to stock in our stores at 130. Okay, should the price of maize go to 130 or 140, I don't care. I'll pay you 130 that we agreed on. Okay, but so that's basically how derivatives can be used in commodity price risk mitigation. Okay, another thing, it's also usually common in companies like that are also have also different subsidiaries in different countries, or even airlines. You know, airlines is basically an international business. Airlines doesn't operate in anyone. So let's say an airline, Kenya Airways. Okay, Kenya Airways operating between Malawi and Kenya that you came in. Okay, so huh, the price of the any supply product, what do they, let's say fuel, they buy fuel, right? When they are in Malawi, they buy fuel, the jet fuel that they use in Malawian kwacha. When they're in Kenya, they buy the fuel in Kenya using the Kenya shillings. So they can use such, for example, commodity futures. Okay, in this case, commodity futures and other derivatives, and also even options, and also swaps, currency swaps, to be able to, they can lock in a price of the jet fuel, like that 1 liter of jet fuel should be 200 Kenya shillings, which should be what did we say the exchange rate between the Kenya shillings and the kwacha is?
15.
15 Kenya shillings.
Yeah, 15 Malawi kwacha.
Is 1 Kenya shillings, yeah, right. So meaning 200 Kenya shillings is around 3,000, right?
Yeah.
So which is 3,000 kwacha. So 1 liter of kwacha, 1 liter of jet fuel is 200 Kenya shillings, which is 3,000. So we have locked that price. Should the prices of jet fuels in the world increase, we don't care. We agreed. Whether we are in Malawi, where when Kenya Airways are jet flying to Malawi, once they fuel in Malawi, they'll pay at 3,000 kwacha. When they're in Kenya, they pay at 200 Kenya shillings for a liter. They don't care. Okay, so that's how, for example, or a business. So that's how a business that have, for example, subsidiaries overseas or operates also overseas can lock in commodity prices using commodity futures and derivatives. Also, or let's say you are a company that also exports goods or operates even multiple markets and jurisdictions. Okay, you have a branch here in Kenya. You also have a branch in another country. The price at which you sell your goods here in Kenya, you can lock it at a particular price to be equal to some predetermined price in your other branch. Okay, but as we said, uh, all these also come with their costs and benefits. I mean, during the drawing up of these contractual agreements between two parties to lock in a price using the derivatives or to swap between currencies in an interest rate derivative swap or options or futures, they all come at a cost, and we look at them a bit later. And you see, this is exactly how even most banks were able to even survive the 2008 financial crisis using derivatives, right? I mean, if you are a bank in if you are a major commercial bank during the 2008 financial crisis, and you hadn't, because the main impact of the 2008 financial crisis was interest rate hikes, right? Yeah, there were runaway interest rate hikes. So if you are a bank and you hadn't engaged in an interest rate futures or swaps and such derivatives, then you had to be really affected during such a crisis. Okay, so they use the derivatives such as interest rate swaps during those banks use those interest rate swaps during those crises to be able to hedge their exposure to the fluctuating interest rates. And so these swaps and derivatives will help you as a bank to, for example, to ensure that you have stable cash flows, right? Let's say uh, hmm, you are receiving some loan repayments as a bank. It's 208, okay? Banks all over the world are facing the 208 financial crisis, okay? You are a bank and you are receiving some interest rate payments. I mean, loan repayments in terms of both principal and interest rate, right? One day the USD and the Kenya shillings is 100. The next hour it's 150. The next month it's 200. That's during the two. So if you are receiving some, let's say loan repayments from a customer, the first month when it is 100, they give they give you 10,000.
Yeah.
When it climbs to 150, they give you less, 7,000.
Oh yeah.
When it climbs, they give you 5,000. So that's a very, very stable cash flow that you cannot rely on, and it will even impact your LM strategy. So if had you engaged in an interest rate swap or a futures contract or other derivatives, then you can be able to hedge yourself against such runaway fluctuations in the interest rates during the 2008 financial crisis. But they are rejoined, and another concepts and our derivatives that we even talked about is arbitrage, where so now as traders or as fund managers and players in the financial instruments, dealers in financial instruments, they can even take advantage of such fluctuations and differences between one currencies to the another. The fluctuations, they can be able to to take advantage of those to create arbitrage opportunities and even profit from them. So, if you are a firm or if you are a forex bureau, you take advantage the price discrepancy, because obviously there are price discrepancies. One Kenya shillings is for example 130 US dollars. Okay, I mean 130 Kenya shillings is 1 US dollar, but the same 130 Kenya shillings is not the same as 1 euro. It's another. It's not the same as so like that discrepancy. You can exploit it. You can buy, for example, Kenya shillings, convert to. I mean, you can buy euros, convert it. So you have euros. You buy USD. You buy another currency. You buy, so exploit their differences to be able to make a little bit profit. And that's basically how trading works in forex trading. Okay. and even not even traders, even banks can. This is how banks basically make profits
Mm.
from forex, right?
Mm.
Through arbitrage. Let's be real. I'm there. We are there.
Oh, the spread. Yeah.
Exactly the discrepancy between forex, and that's why banks trade in all the major G10 currencies. So let's say KCB Bank, which is dealing in all the major G10 world currencies, okay, and it wants to exploit the arbitrage opportunities presented by the difference and discrepancies between the major world currencies. So, or even if it's an interest rate, they can even exploit the interest rates discrepancies and
Differential.
gaps between markets, for example, in the US market, in another market. Okay, so they can be able to use such derivatives in one market to offset the losses or risk that they could suffer in the other market. It's basically hedging one loss to gain another. So it's basically it's an offset. It will offset each other. If you lose in, what I mean is this. Let me just explain it comprehensively. Let's say KCB has a billion Kenya shillings to invest. Okay, it can, let's say, invest in let's say 10,000 USD, and also buy another 10,000 Japanese yen, let's say 100,000 or 1 million or 1 billion, 100 million. So 100 million Japanese yen, Chinese francs, GBP, sterling pound, GBP, sterling pound, Canadian dollars, Australian dollars, buy all those currencies. So, should it lose due to unfavorable USD interest rate and or even forex rate fluctuations and risks, it will definitely not lose on the others. It may benefit, so that the benefits may offset the losses they may incur due to unfavorable price fluctuations in the other currencies they also hold mm, their portfolios in. So those arbitrage opportunities, for example, using the derivative swaps futures, ensure, for example, KCB Bank in this case can take advantage of those price differences between one, and that's why they sometimes can they can make very very big profits, but sometimes
Yeah.
they can. Yeah,
Lose.
exactly. But they usually make very, very big profits due to just exploiting those price differences. Okay. So we have seen the importance of we have talked about derivatives, but no. So now, how does this help? Let's say you are the treasury department of a major bank. How does it help your bank? Like, it's basically, it helps in capital adequacy, to maintain your capital adequacy needs. Okay, because since you are able to use derivatives to ensure, for example, that you don't suffer much of the risk, then you can even ensure that the cash flows that you receive are constant and are stable. Okay, and do not really get affected by the changes in interest rates and also forex rates. Just as we were explaining before, your KCB Bank, you have loaned out a billion Kenya shillings. Customers pay back 100,000 Kenya shillings. No, you have loaned out a billion US dollars. Customers pay back 10,000 USD per month. Okay. And since the USD and Kenya shillings fluctuate a lot due to forex and also interest rate risk, one month, instead of customers bringing in 10,000, since the USD has weakened or has strengthened against Kenya shilling, they bring 9,000. Therefore, that's a 1,000 loss. In your cash flows, you had budgeted for 10,000 because that's what you loaned out, but due to the price differences and the forex risk and interest rate risk, you receive less or more. So, as a bank, you can optimize your cash flow to ensure that you maintain a stable cash flow that is able to withstand the test of time and also the test of such risks. So the bank in this case can even withstand and even economic downtimes if there are runaway inflation, things like the 2008 financial crisis. Such a bank can easily withstand it because they have locked in a price using derivatives to hedge themselves against and mitigate themselves against such forex and also currency and interest rate risks. And so you are able to lock in and be able to ensure that your cash flows are stable, and eventually ensure that that you optimize your capital efficiency and adequacy. Okay. Yes. So let's look at now how we wanted to talk about now the I want us to talk the now the each kind of risk, because as I told you, there are different types of, as we even learned yesterday, right? If it's interest rate risk, there are different kinds of or ways how we can use the each of the various hedging instruments to hedge ourselves against interest rate risk. So I want us to see how we can use the different ways we can use each and every one of the hedging instruments, the swaps, options, and futures, to be able to hedge ourselves against each type of risk, interest rate risk, and forex and the other types of risk. So let's start with interest rate risk. Let's say we have talked about this. We have two types of rates, okay, interest rates. We have a fixed rate of interest for you as a bank have some loan portfolio that are at a floating rate, okay, that is the market rate, and also other portfolios that are under fixed rate, okay. So for example, you can use a swap option called a fixed floating interest rate swap for the bank to reduce your exposure to when for example, interest rates fluctuate or fall or go up. For example, in this case, as KCB Bank, you can use a fixed. You said we said that you as a bank have two kinds of uh, loans or securities backed portfolios. Okay, you have one backed by a floating rate and a fixed rate. So you can use as KCB, they can use the fixed rate loan, okay, and enter into a swap to benefit when the interest rates fall. Okay, you understand, right?
Yeah.
I hope you do. So as a bank, you know interest rates will fall, and you have a fixed rate loan that you are receiving or you're paying. You enter into a floating rate swap with another party to be able to receive or to be able to pay in this case, if you want to mitigate your risk, to be able to pay in the floating rate at the lower rate that it will fall to, because you, for example, entered into a short position that the interest rates will fall. So you can easily lower your debt. For example, if you are servicing a debt, if they paid, for example, they borrowed a debt in the interbank market, they can really lower their exposure and also even the amount of debt they service, because they will have paid a lower amount of debt by entering into the interest rate swap, swapping their fixed loan rate to with the a floating rate. Okay. And also, it can even be vice versa too. You have a floating rate, and then you suspect or you speculate, it's called speculate. You speculate that the interest rates will rise. Okay, you enter into a swap agreement to be able to fix a price, because you don't want to pay past some rate. Okay, yeah. As KCB Bank, you are servicing a loan that you borrowed in the interbank market. Let's say a billion Kenya shillings. You borrowed a billion Kenya shillings. You are servicing it, but you suspect, no, you borrowed USD. Let's call it interest rate. Yeah, you borrowed a billion Kenya shillings. No, let's start with we are talking about interest rate. You borrowed a billion USD, and you are servicing it, but you are serving it at 10%, right?
Yeah.
Per month. No, that's high. It's usually maybe 5%. Okay, you are serving it as 5% per annum. Okay, but you are suspecting that or speculating that it may even rise to 7%. So you enter into an interest rate swap to fix the price. Instead of paying at a floating rate, which you may end up paying at 10%, that it may rise at the 7 or even higher at 10%, you enter into a fixed rate swap to be able to lock it at, let's say, 6%. Should
Yes.
it should the interest rates rise past even 7, you'll pay at 6, which is low, and therefore KCB Bank will have hedged themselves against paying the higher rates of interest in the loan they are servicing. So in that case, it will ensure that they main table, for example, the stable payments. If you are paying 10,000, you pay 10,000 throughout, not 10,000 next month, 15. Okay, and you can even plan. So this can even help you to plan, for example, your ALM strategy, your cash flows, even comply with the Basel III requirements and other capital management and capital adequacy requirements, and also hedge yourself against or mitigate, put down appropriate and effective risk mitigation, and also hedging strategies to be able to protect yourself against unfavorable interest rate fluctuations. So that's how they basically work.
Okay.
Yeah, I think I've given an actual example that's easier to understand. So let's also look now. That was interest rates. Let's look at an example where KCB may want to enter into a currency swap, or use that derivative to mitigate themselves against currency, especially unfavorable currency movements and fluctuations, what we call currency of forex risk. So currency risk it basically involves you exchange the principal payments or even the interest payments of in one currency for another currency. That way, I think we have explained it a lot,
Yeah.
right? Let's say it's cross-border payments, like or international payments. Huh? Okay. KCB borrowed in the interbank, borrowed some maybe from HSBC Bank in Japan. Okay, it's supposed to service this debt in Japanese yen. Okay, but the Japanese Kenya shilling rate of exchange is very unfavorable to KCB. So they enter into a currency swap agreement to be able to lock in a particular exchange rate. No, to be able to, that's a future. To be able to swap, instead of paying in Japanese, they will pay in the other currency. Therefore, the unfavorable currency pairs between Japanese yen and Kenya shillings won't affect them much. Okay, and it's usually used for if you are paying, for example, cross-border or international payments, or if, for example, you as a bank have loan portfolios even in different currencies, which almost all banks has. So on KCB Bank, you are servicing a USD loan here. You also have a Euro loan that you took for a European bank. You also have a Chinese loan that you took from a Chinese yen. Okay, so you can enter into a currency swap to enable you to ensure that you are able to even forecast your cash flows that or your loan repayments, and then ensure that your cash flows from the loan repayments that you make are stable and are not affected much by the currency volatility and fluctuations. And this can also work both even in the reverse. Let's say they are also receiving some loan repayments. Okay, they loaned to customers, let's say 10,000. One customer they gave 10,000 USD to pay them back in 6 months. To another customer they give 15,000 euros to pay them back in 6 months. From another customer they to another customer they gave out 20,000 Japanese yen. Okay, they can enter into a currency swap instead of the customer that is paying them in USD, since USD has maybe moved unfavorably against them, to pay them in Japanese yen, which at the time may have moved, we may have fluctuated favorably against them. So that's basically how currency swaps can be used, and derivatives in general can be used to protect the company, in this case the bank, either a commercial bank, a reserve bank, or a central bank, from exchange rate risk and volatility, and ensure that you can even be able to meet your obligations. Okay, because if you suffer from too much currency and forex risk, then it will even affect your ALM, your capital adequacy, and eventually your ability to even pay your supply. I mean, pay your short-term obligations. If there is a surge in withdrawals, if there's a market crash, it can really affect you. It did affect some banks, for example, in the 2008 financial crisis. Mhm. Okay. Let's also now that was on swaps. Okay. I'm trying to condense them so that we look at one at a time, okay, so that we understand. So I've been talking more about swaps, right? Or you can lock in, you can swap one interest rate for another, a floating rate, for a fixed rate, or a Japanese yen for a USD. We also call currency swap. So let's now how you can use options. Options, as even from our previous discussions, here is you set a cap and a floor. Okay, let's start with interest rate. Interest rate. Okay, so as KCB Bank, still, KCB Bank, you are receiving some, you are receiving some loan repayments from your customer that you loaned out to. Okay, let's say you give out a loan that's supposed to be repaid at 10,000 Kenya shillings, representing a 10% interest rate. Okay, no, 10,000 USD. Okay, no, yeah, 10,000 Kenya shillings. So these are an interest rate option that I want to explain, so there is no need of going into multiple currencies. So 10,000 Kenya shillings are 10%. Okay, but the CBK could wake up one day and decide that the interest rates are 7%. The way they just did yesterday. I mean, customers used to pay at 13%. All of a sudden, they are paying at 17%. And then yesterday, they reduced the base lending rate from 12.75 to 12. Okay. So KCB doesn't want that, because one day you are receiving 10,000 that you're supposed to be receiving. The next month, CBK has reduced the base lending rate. So you are receiving, let's say, 9,000. KCB, you don't want that as a bank. Okay. That's unstable cash flow movements, and it can affect your Basel III compliance, the Basel III requirements of the central bank, or even your capital adequacy ratios, the UILCR, the liquidity coverage ratio, the UISFR, the net stable funding ratio, UIHQLA, high quality liquid assets, and all the other TCR, CT1 requirements, all those liquidity coverage and ratios. Okay, so you want to lock in a price that will be able to hedge you against unfavorable interest rate option. So you come into an agreement with the customer, with another party, with the other party, that I know I gave you a loan that you are supposed to be repaying at 10%. Okay, but should the CBK wake up and one day and decide that the interest rate is at 13%, no, you won't pay that. That's too much. I want you to be paid at 11%. Okay, should the interest rate move past 11%, you'll pay me at 11%. Should they be reduced by the CBK, let's say to 7? No, that's too low for me too. So yeah, let's say at 9%. So should they move below 9%, below 10%, you'll pay at 9. Should they move past 11%, you'll pay at 11%. So the cap is 11% and 9%. I mean, the cap is 11 and the floor is 9%. So it will provide you, both parties will benefit, but obviously only one party will benefit at a time. Yeah. Okay, so it will provide you as a bank, and also even at a customer, the other party, against rising or falling, generally the fluctuating interest rates. Okay, by you set up an upper, by an upper limit. Should it move past that, then you'll pay at that predetermined rate. Should it move below some rate, you'll only pay at the rate that we agreed. Okay, so that's how options can be used by banks. Okay, let me also explain how now also currency flows and FX currency options can also be used. Let's say you have an option. Okay, let's say you are a business, you are a bank. You okay? Let's say you still use KCB's example. KCB is in Kenya, and also they are Congo. No, we are using that example. Let me try to look at another. Another. Okay, let's look at the previous example where you are an exporter or importer. In this case, I want to buy bulldozers from China. Okay, so my Chinese supplier expect me to pay them in Chinese yuan. Okay, yeah. But they think maybe the Chinese yuan will move or will weaken against the Kenya shilling. So if we enter into, for example, a put option, the the supplier will secure, for example, will lock in a particular exchange rate between the Kenyan shilling and the Chinese yuan, so that should it move past that, then we'll be able to buy back our investments, and therefore we will be able to sell the assets, and therefore we will have benefited from that unfavorable Chinese yuan, Kenya
Yeah,
shilling
Kenya shilling
exchange rate. Exactly. So that's how it can also even be used in the case of an foreign exchange risk. Okay, you set you have an option to pay. You set a particular exchange rate to be able to. Should it move unfavorably to you, then you'll use the predetermined exchange rate of between Chinese yuan and the Kenya shillings. Also, even a call option. So now that one is the example of a put option or pull or sell. So now a call or a buy option. KCB Bank give out a loan in euros. Let's say KCB Bank, I gave out. Let's me I'm KCB Bank. I gave out a loan in euros, so I'm receiving interest rate, interest and principal payment in euros, right? Okay, but as KCB, I am my treasury managers at KCB in the treasury department are concerned that the euro the euro and the Kenya shilling might, for example, the euro might move unfavorably against, or might weaken against the Kenya shilling, which is very, very rare. So I can buy a put option, which gives me the right, but not the obligation, to exchange my euros for Kenya shillings, but at an agreed. The point and the key point is it has to be an agreed exchange
point.
rate before predetermined exchange, so that I will have protected myself from if there is any adverse or unfavorable exchange rate fluctuations between the Kenya shillings and the euros that I'm supposed to receive in the interest and principal payments of the loan that I gave out. Okay. So that's that. What have we not looked at? We have looked at swaps, both of interest rates and forex rates. We've looked at options, both call and put of interest rates and also of forex rates. Let's also now look at the last kind of derivative type of derivative. That's the futures, right? Mm. That's still we are still talking about futures, derivatives, futures, options, okay, and swaps, and how banks and especially even traders, exporters, for example, can use them to manage risk and mitigate and put in place risk mitigation and management strategies. Okay, and then so now we'll also even look at the strategies, hedging strategies that we are now. No, that's next. Okay, okay. So that's the last kind of derivative we are looking for. We are looking at that's futures contracts, and we have talked about it already. We are just even in the process. At this point, we are just reminding ourselves, right? Right. So futures contracts, we say that it's an agreement, for example, to sell or buy a commodity or an exchange rate or an interest rate to exchange at a particular in the future at a particular point or rate or price in the future, but at a predetermined or pre-agreed price or interest rate or currency exchange rate. Okay. And as we said, with all these agreements, they have to be predetermined. I mean, they all have to be defined even at the point of entering all the details relating to them. For example, the quantity, that or the dates, things like that. Okay, and the rates mostly. Okay, and we even looked at one that is a little bit more stable, that's used in the Chicago Mercantile Exchange in relation to how we can use that hedging strategy, that is a future to hedge ourselves against that kind of risk. So let's start with interest rate risk. So interest rate risk, let's now see an example where we can use an interest rate future. I mean, you can use futures to hedge ourselves against interest rate risk. So let's say we are paying some debt. Okay, we're paying some debt at a particular interest rate. We could enter into a future contract. Okay, to only be paying it at a specified rate. Should it move past that rate, then we'll only pay at that rate. Especially if it will move with unfavorably to us to what we expected. Okay, Okay, let's also look at an example of in a bank. Let's say bank, you have some, maybe some b- bonds. You bought some bond portfolio. Okay, so you have a bond portfolio. So you can, in this case, and you want to secure that, you want to secure the returns or the cash flows from that bond holding that you do in your portfolio. So you as a bank, for example, you may draw up an interest rate future agreement to be able to lock a particular exchange rate of that bond. Okay, should it move unfavorably, then you will have at least reduced the risk that you are exposed to. Okay, and similarly to foreign exchanges. If you are, for example, an importer, I'm exporting some goods from another country, from let's say China. Okay, I can use, for example, foreign exchange futures to lock in a particular exchange rate between the Chinese yuan that I want to pay the bulldozers at for the payments that I'll make. Should they move unfavorably, then I will have locked at least not even made a profit, but at least protected or hedged myself against.
Defensive.
Sorry.
I mean, being defensive.
Exactly. You attack while defending. Okay. Mhm. So, huh. I think that's it. Right? Is there anything that we haven't discussed? We have talked about how derivatives are used in treasury management. Where we have gone deep into how each type of derivative or which kind of derivative contract can be used in each of the types of risk, both especially interest rate and forex risk. We have also even looked at now the particular hedging strategies that we can use. For example, call options versus put options, interest rate swaps versus currency swap. In each case, in each type of in each type of risk, and also in each type of derivative. Okay. And also, most companies, even just by the way, most companies they do this because let's talk of a bank. Okay, a bank is one company that engages in a buy and sell transaction. At the same time, they lend out. At the same time, they are also expecting to receive some in terms of deposits.
Yeah.
So let's say you, as a bank, let's say I'm KCB, I'm expecting to receive some USD deposits from customers. Okay, but at the same time, I'm also expecting those are liabilities because I'm expecting to pay them out. At the same time, these deposits that I've received from a customer, USD deposits, I've loaned them out, and I'm expecting to receive payments, interest and principal payment. So I can use a hedging strategy. Let's say, for example, the different hedging strategies, natural hedging, where I align these. What I mean is this: you're expecting to, the customer gave you 10,000 USD, right?
Yeah.
They will expect to be paid in let's say in 2 months, just for simple. Okay, they expect to be paid in 2 months at of let's say 2 months of installments, or two installments, that is, of 10,000, of 5,000 each. Okay, 5,000 each, right?
Yeah.
But the 10,000 the USD they gave you, you also don't store it somewhere. You give it out.
Yeah.
If you give it to a customer,
In some.
exactly, so that you make a little bit of profit. Okay, but the customer, you have to be the treasury manager at the KCB bank has to be smart to align this. The customer, for example, the customer will need their first 5,000, let's say on the 1st of December. But you have to be smart also to receive that. Should the customer you gave the 10,000 to, they should also be pay at least on the 31st of November, on the next day. So you align them kind of. Their first payments of interest and principal should also fall at least even on the same day or the day before. And that's just an example. You align those cash flows of what you are expecting to receive in assets, and also what you are expecting to pay out in terms of the liabilities which are the debts that you or deposits that you hold. Okay, so that's a hedging strategy. You can, it's called natural hedging, basically. Natural hedging, you use the different cash flow cycles to lock in or to align your cash flow that your receipts are aligned with your payments. Okay, and that way, that's also a hedging strategy. In fact, we may even classify it not as a derivative, right? It's not a derivative if you really think about it. Let's just call it natural hedging.
Okay.
That in that case, to some extent at least, because I mean obviously that still some other kinds of risk, credit risk and also default risk. I mean, you loan the 10,000, they also fail to pay you and refuse to pay you. What will
Yeah.
you do? Okay, but I mean, let's all assume that's not there. Okay, the customer will pay us in time. Okay, so the treasury manager uses a hedging strategy called natural hedging to align this cash flow such that the first payment that you expect to receive of the loan that you give out coincide with the first payment that you are able to that you are needed to pay back to the customer. Eh? Rather than just a minute. I think I hello. Hello sir. Yes. I'm fine sir. Yes. Yes. Yeah. Okay. All right. Sure, sure. In fact, we also have that similar schedule. We are all planning the same. Okay. Sure. Sure, sure. All right. Thank you. Okay. Yeah. So, what were we talking about? Natural hedging. We classify it as a different kind of hedging strategy or risk mitigation strategy, and or as opposed to a manager who prefers the customer give you 10,000 USD that you also loaned out. The customer who gave you expect you to pay them back their first 5,000 on 1st December, but you in the contract that you loaned with in the loan agreement, you told the customer to first pay you